Hello everyone, Godre here, and this is my money brief. Yeah, so on this episode of Money Brief, I want to talk about Eurobonds. So, I mean, to the surprise of a lot of people, Nigeria raised about $2.2 billion from the Eurobonds market yesterday. A lot of people weren't expecting that. This is the first time we're going to Eurobond in I think 2 or 3 years or thereabout. We haven't typically most of our debt borrowing has been from either the last one we did, which was diaspora and local Nigerians, was basically sold locally here. It wasn't sold in the Eurobond market, and then of course maybe some of those World Bank loans. So this is essentially the first Eurobond that we've done in a while, and so that's why a lot of people were surprised that this was happening. $2.2 billion was raised, and from what I gather, there were two issues actually that were done. I think the first one was at 9.9%, if I'm not mistaken. Let me just check that out. I think it's about 9.6%. I beg your pardon. Yeah. So that was a 6.5-year bond. $700 million was what was issued, and then there was another $1.5 billion. That one was a 10-year bond at 10.375%. So, what is the good, the bad, and the ugly? Man. All right, so let's start with the good. So the good thing is we got an oversubscription. Subscription levels was, from what I gathered, almost about $9 billion or thereabouts. So that means a lot of people want to basically buy Nigerian debt, which is good. So you had over 9 billion or so in subscription, and then we sold $2.2 billion. So we did take less. So if you wanted to take the entire $9 billion, we would have taken the entire $9 billion. So the fact that you can actually get this much subscription for a bond, it's kind of like a good thing, shows that there is some kind of faith in the economy and in the ability of Nigeria to repay that debt. So it is a good thing that we can borrow and get this level of subscription. I don't know how many countries, at least within sub-Saharan Africa, have been able to borrow at this level of oversubscription. The funny thing is that we tend to get a lot of oversubscriptions even for local debt borrowing as well. So it's a good thing. Perhaps means that there's faith in the economy, faith in government policies, and so that is probably why you're seeing investors, wanting to own this bond. That is the good. And then the other good thing, of course, is that would help fund some of the government's fiscal deficit, which has been the reason why it's been going to the debt market to borrow. So you all recall we are spending more than we earn in terms of income, and so to meet that gap which is called fiscal deficit, you need to borrow, and so that's why the government is borrowing, and so that money can be used to pay for a lot of the projects that government wants to finance. And of course, the other good part of it is that also provides liquidity for our FX market. So that money is obviously going to go into our external reserves now. But what is also, some people would also mention is that there is also some payment to be made. I think there is a bond that is due next year, 2025. Eurobond that is due for payment in November. So maybe that might go towards it, or we could also raise another bond around that period to finance it. So there's really nothing imminent in terms of any debt repayment now. So it looks like it's not a bad deal at all. So looks like people really, that money could go towards FX liquidity, which we all should be happy for. So maybe perhaps we might see some stable exchange rate at least between now and the end of the year, so we can have some breather for exchange rate. I think this is, I beg your pardon, this is some of the positives that I see. Now, in terms of the bad. So the bad here is 10.3 3.75%. Ewo, for $1.5 billion and 9.6% for $700 million. That is steep. Like, that is expensive borrowing. A lot of naysayers will tell you that is basically junk borrowing. That is the sort of interest rate you pay for what they call a junk bond. Junk bond is like, you know what? That's like, this is the kind of interest rate. Like, I'm not saying we're bad, but it's the kind of interest rate that tend to go to countries that tend to default, when it comes to payment. So that's why this one is a little bit strange. And I was looking at the bonds that we have at the moment and their yields, because you can, from the current bonds you have, you can to an extent have an idea of where pricing can be. And most of the bonds that are above 10% are bonds that are maybe due in over 10 years, right? There's a 2038 bond that is going at 10.2. There's another one, 2047 at 10.3. The highest is at 2050. 51 at 10.5, and that's another Eurobond. So because the longer the tenure for the bond, most times the longer the higher the yield. I just don't know why we're borrowing at this sort of rate, because this is obviously the sort of rates that companies tend to borrow for, not sovereigns. So I guess maybe it's just the way the market is. I was speaking to the trader yesterday, and the trader was saying, well, it's just bad timing, I guess. Maybe the timing of this particular bond sale is at a period where interest rates are still pretty high. So remember that the US Fed is cutting rates, but they're not cutting. They've not cut to a level where you start to see it affect global interest rates. And so, perhaps that is why this rate is high. And maybe that is even why we saw the subscription that we're seeing, because, 10.1%, man, that is an incredibly juicy interest rate to be paying at this moment. The one we did locally was about 9.7%, if I'm not mistaken, around that range, slightly over 9%. And the previous bonds that we've been doing, if I recall, is about 7 point something, max 8%, 10 point something percent. It's pretty high, and of course, it's not all of it that is 10%. There's another 9.6% for $700 million for 6.5 years, and then $1.5 billion at 10.375% for 10 years. That is the bad side of all of this, and pretty high for me. And the downright ugly is that this just adds to our debt portfolio, especially foreign debt portfolio. And it's a debt, and that debt has to be paid, right? So, which means the amount of money we need to service debt has just increased. I did mention in one of my money briefs that we now spend more on debt servicing than on recurrent expenditure. In fact, debt servicing at some point it's going to gap recurrent expenditure and capital expenditure, respectively. So, and that's pretty ugly, because when you start to have this sort of high debt levels, then you just keep borrowing your way out. I know we tend to speak to debt to GDP ratios of being low, but our debt to GDP ratio is now inching towards 50%, if not more than that. And the problem actually isn't even debt to GDP ratio; it's debt service to GDP ratio. So that means more pressure for us to repay this debt, and repaying this debt would have to be more taxes, right? So more taxes, and then the government will probably have to find ways to increase oil exports, right? And then also other kind of export to pay. You're going to be paying this money in dollars, and so when you're paying this money in dollars, you have to find a way of of paying it. And paying it means that there's very likelihood that there's going to be a lot of sacrifices down the road that we all have to sort of incur. And so that is downright ugly for me. And one of the things about this whole, debt, that I'm just wondering whether, I don't know, is it really something that we should be doing at the moment? Borrowing this much money, I don't know. It's a bit disturbing. Now, the other thing with the high debt level is that it could also have its own effect on exchange rate. So your exchange rate could also be impacted, because I mean foreign investors see these things, and then they could as well say, you know what, you guys have too much debt, and so because you have too much debt, they're probably going to want to have you consider perhaps maybe depreciating your currency. So that's just the part that I'm kind of worried about when it comes to this Eurobond borrowing. So that is downright ugly for me. It's adding to our entire public debt. Interest rate is likely going to increase because of this borrowing. Interest payments from Nigeria is likely going to increase because of this borrowing that we're doing. Apart from that, it's likely going to crowd out the private sector as well, because there's likely going to be more borrowing even by the government as we go on. So I don't really know where all this kind of ends. We do need debt, like I mentioned, for us to meet our budgetary expenditure or budgetary obligations. But the sooner we're able to maybe increase exports and maybe grow government revenue, the better for all of us as a country. So that's just the downright ugly part of all this. External debt now, it's maybe roughly $42 billion. If you add this to it, you're looking at maybe 44, so close to $45 billion in external debt. And this was as at June, I think. So we don't know. It's probably even more than that at the moment. So we're probably over $45 billion in external debt levels. So yeah, so that's the good, the bad, the ugly of this Eurobond. For those who are invested in it, 10% is awesome return. Let's just hope that Nigeria doesn't go the way of Ghana, where we defaulted. I don't think we're anywhere close to that yet, but you never know. And so we're going to be looking at these numbers a bit more carefully, and then of course I'll always update you on this money brief. All right, so that's my money brief for today. Do have a profitable week ahead.